Thanks for tuning in to Bloomberg Quint. My name is Neeraj Shah. Well, there's a lot of uncertainty in the market, especially after what the government's move of reducing the excise and asking the OMCs to bear some burden of that cut as well, and of course the states too. So that's got a resultant impact in what was on the OMCs and the upstream names in what was anyways looking like a very weak market. To talk about what all of this would mean, as well as whether the earnings picture does look like it will stabilize or can it worsen further, special guest Ganeshram Jayaraman. He's Managing Director Institutional Equities at Spark Capital, joins us right now on the show. Ganesh, good having you. Thanks much for joining in. First the news, and then we get to the larger earnings piece as well. Would want your thoughts there. But this move by the government that they've done, one, the direct impact that it has on the impacted companies, which is OMCs, ONGC, etc. But first, the impact that it has on the market sentiment. The government has shied away from doing any intervention thus far. Is this the first sign, and will the market believe that this is the first and there could be many more to come?
See, I don't think the street really saw this we'll see it as a surprise, if you ask me personally, because whenever we have had elections in the last 12 months, there has been a pause on the OMCs taking price hikes. So I don't think the street really saw the genuine pricing power existing with the oil marketing companies. I'm not surprised, because this was coming. It's a question of what is the absorption capability which the Indian consumers have. I think clearly you could see that it has reached a stage where beyond this it will start hurting overall sentiments. So from the way I see it, for every 1 rupee cut on excise duty which the government takes, the fiscal burden goes up by about 11,000 crores. And if it's a rupee and a half, you do your math. And I don't think we have seen the last of cuts also, because prices have gone up to $85. And that will have its impact on the end pricing of the consumer. States will also follow suit, and that is unlike the center. The states are ad valorem on duty, whereas the center is on a per liter basis. So states will also follow suit, and in effect will try to bring down the end price for the consumer. The price will be paid by fiscal deficit going up, and that indirectly comes to it will have its effect on bond yields. It will have its effect on liquidity, because the government will have to find, to the tune of at least 15,000 crores, some other revenue source to offset it, which means you will have to see duties go up. You'll have to see some taxes on something else go up. You'll possibly have to see GST cuts which were expected possibly not come. So these are all, it comes back. It's the same piece. In some form, liquidity,
sure,
it'll in some form get impacted a similar way. So this is the crux of where we're seeing this.
But what does this do, if anything, materially to the market sentiment as well? Because hitherto the market has believed that there will not be any meaningful interventions. If the market starts believing that there could be meaningful interventions, one is the impact that it has on oil marketing companies or ONGC and the likes, and we'll get to that as well. But two, the impact that it's had on the market sentiment, that if this is going to be the nature of the game, and if there are more populist measures that are going to come, then the market, which was anyways looking weak, should this weaken further?
Election year, so we have to prepare for some kind of populism. Okay, we cannot be completely rational when prices are volatile, and at the end of the day, the government has to go back to the people seeking a mandate for 2019. So some extent of leeway is something that market has also been prepared for. Otherwise, these stocks would not be down 40% in this calendar year. Right? Oil marketing company, we have been having price hikes. There have been other issues also, but market has not completely believed that oil marketing companies have pricing power. It is believed that at some stage, and that stage isn't too far, at some price there will be some nudging, some pushing, and this was on the card. So genuine independence in taking pricing was something I don't think market really expected as whenever oil started going up.
So what happens next for some of these stocks? Because a bunch of analysts that we've spoken to on the sell side, some of your peers as well, some of them were mentioning that they are pricing in the worst, pricing in negative marketing margins. Now we might actually be staring at a situation like that. Post the fall today and steep falls as well. Are the oil marketing companies first, and then we'll get to ONGC, are the oil marketing companies, to your mind, pricing in the worst, or is the fear of the unknown going to keep them in check?
We are still not recommending buys on them at all. We will still want to wait and watch. I don't think we have seen the worst of their numbers come or their expectations price in. They can be. We'll still be wary of recommending them to our clients. Stay put in that recommendation.
Interesting. What about the upstream names? Because hitherto there has not been an intervention, and while the ONGC annual report stated that we could prepare for it, but hitherto there has not been any. We were speaking to R.S. Sharma of former ONGC, and he mentioned that according to him, looking at the international situation, some bit of intervention in ONGC is also around the corner. Would you believe as much? And therefore, is that something that caps ONGC or becomes a negative for ONGC?
Inevitable.
Inevitable.
Inevitable. Question of time.
Question of time.
Who has to? Somebody. See, we need more hands to share the burden. Okay. Some you ask us to consumers to bear it. Government has to bear it, which is what they are doing now. Some burden is passed on to oil marketing companies. That's the nature of the market that we have. Distribute the pain so that one person, one segment doesn't bear all of it. So if government bears all of it, it is a fiscal big impact. If oil marketing companies or oil producing companies bear it, so it's a question of distributing the burden. That's the way. That's how the market works.
So you would be negative to neutral on upstream as well right now?
Absolutely.
Okay. Okay, great. So that is the one key news piece out of the way. Now let's talk about what's happening to the broader end of the spectrum as well. I think the one thing that stood out for me on your note is the headline itself, that time to wake up and smell the coffee when it comes to earnings growth expectations. Now, can you tell us what is it that, what are the numbers that you are working with, and how does the math therefore work out as per those calculations?
We've been most cautious in the street. For now 12 months, we've been highlighting risk after risk. Practically all of them are playing out. In fact, playing out more intensely than we thought also, and faster than we thought. I think the street is still uber optimistic on earnings growth expectations. It has to get moderated.
Define uber.
20+% earnings growth is on the cards as per the street for fiscal 19 as well as fiscal 20. First half fiscal 19, it might come because of the base effect. Same 2 quarters last year was GST impacted. So if you see a 2-year CAGR instead of year on year, it's not as optimistic as it appears. Second is we had a phase of very good tailwinds till 6-9 months back on interest rates, on liquidity, on bond yields, on commodity prices, on the currency. All of this tends to have its lingering effect on earnings for a while. Companies would have signed up on contracts, companies would have tied up for pricing. So that tends to be a bit of a breather till it catches up. We think second half of this year will be the true test. We think fiscal 20, calendar 19 is actually the real big test. On that point, I'll tell you how the street is basically penciling in. They're expecting volume growth to sustain. Price hikes to be taken because of input prices having gone up, rupee having depreciated, and operating leverage to continue, meaning EBITDA margins will hold or in some cases improve vis-a-vis their last 5-year average, 5-year peak, for about 55 to 60% of the stocks. What this virtually tells me is all the raw material price increase, currency effect will get passed on without impacting volume growth, without impacting operating leverage. So earnings growth will actually, this effectively telling me that inflation or all this in fact will be earnings accretive. I contest that. I think this will be put to test because there are multiple tailwinds which have become headwinds which will hurt this. I put it in 4 buckets. Let's look at one by one. Firstly, I don't think the rupee at 73 odd should be seen as a numerical number punched into an Excel model, which will mean imports get costly and exports become cheap. That's a very naive way of looking at it.
Okay.
The way I see it is, if the world GDP is a pie, India is losing market share. Okay. Why is the rupee depreciating? Money is shifting, growth is shifting from our pockets into somebody else's globally.
Right.
It's moving from us into, say, an oil well owner in Saudi or in somewhere in the Middle East.
True.
It's going into a Chinese mobile manufacturer. It is moving, changing hands. We were the beneficiaries of this. when rupee was appreciating, when commodity prices going down, we were gaining market share. Now we are losing market share. And that means growth will have to get moderated. In absolute terms, our expectation is current account deficit will be about $30 billion more than the capital account surplus, conservatively. Which means to that extent, money is moving hands. And that means it's about 2.25 lakh crores, which is about 1.2% of our GDP. It will have its effect.
Okay, there's a numerical impact to this as well, right? There are enough and more people who are now thinking of, with the currency having moved the way it has moved and as swiftly that it has moved, could lead to impairments, could lead to forex losses, which might bring down the EPS number for a bunch of companies, even though you may argue that there are one-offs, but it will bring down the EPS number and therefore the growth numbers. Is that a real and present danger?
I mean, that is obviously one, not all companies, but yeah, there will be some section of companies who were having unhedged liabilities. But RBI over the years has been tightening this. In some form they've kept provisioning requirements high for banks who had lent to companies who had kept it unhedged. So there was some kind of leverage which was being used by the central bank. But the key point in that is this effectively means that companies will have to absorb the forex pressure in their pricing. In some form it has to get passed on. And there I question its ability to pass it on. The ability for companies to absorb that and assume that this will be seamlessly passed on without having an impact. That is something which I question.
Which again brings down earnings, right?
Yeah. So if you see most raw material prices in rupee terms, be it metals, rubber, coal, agricultural inputs, we are at close to a 6-year high in rupee terms, well above the 2015, 2016 levels. If we say that this will get seamlessly passed on, we are virtually telling that the average company has pricing power. History tells us, if you have to go by the last 10 years track record, just about 10% of the companies that we cover, and we cover about 220 stocks, less than 20 companies have genuine pricing power, meaning they have an ability to pass it on without impacting volume growth and have sustained their margins. That virtually means the top decile companies who have this track record across cycles. But estimate seems to suggest that even the average 50th percentile company will be able to achieve this.
That's almost 2 quarters. That's what the street, you believe the street is pricing it.
Precisely. In some form, I'm saying that such pricing power doesn't exist for all.
Okay, so let's try and break it down for the benefit of our viewers. What are the spaces that are likely to get impacted or hit the most? Currency, I know, would be difficult to price in. What about the commodity prices? Would you believe auto companies, despite the volumes holding up, could face margin pressures, and will that show in the EPS numbers for these companies, eventually bringing down the Nifty EPS as well?
No doubt. It will have an effect primarily on cost of capital, which means automobile companies for whom 80-85% of they might be cash rich as companies, but their consumers take leverage to buy any automobile product. So if cost of capital goes up, cost of borrowing goes up. Now let's just put these in scenarios. The government, even after announcing last week that they will borrow 70,000 crores lesser, in our assessment it will still be 20% more than what they borrowed in the first half. Central government and state governments put together. The second is the bond markets have slowed down. The commercial paper, the mutual funds, even the overseas borrowing has slowed down. So the burden of lending has fallen on banks. Okay, which virtually means that banks need to show credit growth of 13% year on year, heavily back-ended this financial year, to sustain this growth. And that growth is needed for a 6.5% GDP growth if you add all forms of funding. And that means the government is going to borrow 20% more. Banks need to keep that also in the fray while reckoning how much they have to lend to private. So the crowding out effect is inevitable. Thirdly, which is actually a bigger risk, is the Reserve Bank of India is virtually selling, they've sold about $16 to $17 billion of forex reserves. to support the rupee. This is April to August. If the Reserve Bank of India continues to support the rupee, virtually what they are doing is they are selling dollars and buying rupees. So they are sucking that liquidity out. Now, if they effectively need to do, in our calculations, about 2.7 trillion rupees of open market operations in the subsequent 6 months, to meet the capital requirements of both banks' credit growth requirements and government's borrowing program, these two are dichotomous. On one hand, RBI has to do open market operations, helping liquidity. On the other hand, to support the rupee, you have to suck liquidity out.
Right.
This puts them in a catch-22 situation. We have a bit of a gridlock here. And my assessment is these two are at loggerheads. They cannot do both. They have to find a middle path, which is support a bit of liquidity, not fully, support a bit of growth, not fully. A bit of evening out in both, a bit of a narrowing down of both is inevitable. That's where I question the earnings assumptions which are baked in, which seems to assume that it's tailwinds, businesses as usual. I guess the last 2 weeks, markets have been ahead, and my sense is over the next 4 quarters, earnings expectations will get moderated. So, which is the whole headline of the note. So you have to wake up and smell the coffee.
So is that, do you reckon that that's in or around the prices that the market is right now, valuation-wise, or just pure valuation and not sentiment could take the headline numbers lower? I know it's from a AMC perspective or otherwise, you look at your coverage universe or your portfolio, but let's face it, the headline number on the Nifty or the Sensex does impact sentiment too.
No doubt.
So for the headline number, is this pricing in the earnings numbers, or do you reckon that pure pricing of the multiples that you assign to a 455 plus whatever % growth that you're giving to the Nifty EPS should mean that the Nifty should not be at 10,500 but should be at 10,200, 10,000 or lower?
I tend to look at markets movement in 3 phases, typically, and this is a pattern which the market has followed for possibly 20 years. Phase 1, stocks tend to go up or go down, and it appears that multiples are going up or multiples are going down. And we think stocks have become costlier or cheaper. This tends to be in the first 12 months, which is what we are currently in the last 12 months.
Interesting.
Phase 2, earnings catch up. Either earnings go up or go down, which happens for 3-4 quarters. And we then realize that actually multiples didn't go up or go down. It was earnings which went up and went down. And then market realizes that for the higher growth or lower growth, the multiples need to be accordingly adapted.
So you're saying that period is the next 12 months coming up?
Next 12 months is earnings moderating phase. By the time that happens, I don't think you can clearly compartmentalize this. Seamlessly you will happen, or which practically means in our assessment, next 4 quarters, these two will happen simultaneously or over a period of one, overlapping each other.
Sure.
That is next 12 months.
And then the phase 3 is?
That's where the real, multiples reflect the fact that earnings have slowed down or cash flows have deteriorated. Actually, I'll highlight one more point here. 15, 16, 17, 18, in those financial years, earnings growth was muted, but cash flows were still very healthy because the raw material prices had fallen, commodity prices, so inventory, receivables, and the working capital requirements had come down. So cash flows were growing healthy and not much capital expenditure, so free cash flows were very healthy. We were in a phase of deleveraging. And cost of capital came down 250 bips. This helped stock prices. But now if earnings expectations for next 12 months slow down, cash flows have already started deteriorating, and cost of capital is going up, we think valuations will have to start reflecting this. And the sectors which will be seen are the domestic cyclicals or the discretionary consumption pack, the capital expenditure, the government spend dependent sectors, oil marketing companies definitely, and companies which were in some form beneficiaries of the last 4 years, financials. Those all have to moderate on expectations and multiples.
There's already been some moderation in some of these pockets. Leave out consumers, the others have already corrected for other reasons, of course, but they have corrected.
Multiples have corrected, earnings expectations haven't corrected.
But you think that there is scope that if the earnings expectations correct further for some of the financials, then there could be some more moderation in those stock prices?
Yes.
And would you extend that argument to retail-focused private banks as well?
Not all of them, very stock specific. someone is also going to gain market share okay, in all of this. Someone is also going to say that basically means the well-capitalized banks will gain market share from NBFCs who are going to be a lot more uncompetitive on pricing, will gain market share from the state-owned banks who don't have capital. So I will not want to say and blanket or paint all banks with the same brush. I will be very, very specific. Time-tested managements who have a track record which has reflected their capabilities over not just last 3 years when the weather was good. It's basically across cycles, which means 10 years. So 8 to 18, 9 to 19 is how I tend to see and prepare ourselves.
Okay. Last couple of questions. Firstly, on the export-oriented sectors, you started off saying that that's a space that you seem to be bullish on. Have TCS at 26 times. You may be bullish on that, but surely there is some roof that TCS will have to cross in order to gain further, unless the earnings delivery just outstrips the expectations. What do you think will happen?
See, again, I don't want to sound like rupee depreciation is a
I'm not talking about the
technically,
rupee right now.
But what this does, technically, what it always does is it makes the exporters more competitive. Okay.
Sure.
Which means dollar or constant currency terms growth should become better vis-a-vis the last 24, 36 months when it has been very, very muted. That is what I am expecting to play out. Of course, there is an immediate translation effect on earnings, which I don't think market will give a P multiple on top of that.
True.
I guess it will be seen as one-off, okay, adding to cash in some form. But structurally, if vis-a-vis 63, if at 73, if I'm an IT company bidding for a project, I can price in a little better and try to edge out competition and try to win some projects, which is what I'm saying is something which we don't know. We have to see, and I think that's something which I will want to watch for. Secondly, on the pharmaceutical space, the pricing impact which the generic drugs had seen pretty much for the last 3 years, we think it's moderating. If there are indices which track the top 200 generic drugs pricing movements, which I have moderated. Which in fact, instead of price cuts, it's gradually going back to more sensible levels. I think that is a tailwind which we are very keenly watching. Even the ANDA approvals have started improving in the last few months. So our assessment is the companies, there are pockets of value. What I mean as value is earnings have value amongst some of the pharmaceutical names. That gives us comfort that between these two sectors, we will not only protect capital, but we'll also make profits, make money in this ensuing 12-month period.
Interesting. My last question. What is it that within the domestic focus space are you either most bullish or most bearish on? Cement, while capacity additions may have gotten postponed a little bit, the stocks are in a state of flux, to be honest. The commentary from India Cements was very robust about, it's not often that you hear a cement company say that states are gobbling up cement, but somehow that's not really leading to any kind of uptick into any of those names. The infrastructure focused names just completely disregarded by the market right now. Are you bearish, bullish, neutral?
Cement, we have been bearish. Okay.
And you continue to remain bearish?
Remain bearish for reasons like three. One, the demand was largely led by government infrastructure spend. With how we see the fiscal take shape, we think that will moderate. And it has already started moderating. It tends to show up on cement demand with a 3-quarter, 4-quarter lag. Supply, contrary to what we thought initially, over the last 2-3 quarters, we are actually realizing that one, the NCLT impacted supply capacities have actually started coming into the market, and fresh capacities also, which are more brownfield, not greenfield, have actually also started. So supply is continuing, and demand likely to moderate, and supply continuing, coupled with rising costs. We believe the EBITDA per ton expectations, which are in excess of 840 to 850 rupees, we think that can moderate to below 800. And that is where we think there will be earnings downgrades in cement. So we have been more skeptical on cement as well. What we are positive in the entire domestic space is quality staples, consumer staples. They are costly, but costly for a reason. They have time-tested track record, which tells that they have pricing power. And rural economies are also, it tends to always be a tailwind for staples stocks, staples companies. We believe that with rural buoyancy likely to continue, our assessment is the improving volume growth which staples companies have started showing in the last quarter or two will continue. And couple it with price hikes or pricing power, which they have historically demonstrated, we believe that those companies' earnings are not at risk. Okay. Earnings are stable, balance sheets are more robust, managements are credible, and our assessment is, though those stocks are extremely expensive, we will want to stay put with quality at this point in time. So quality over cyclicals is been our preference, and we stick to that.
Well, and wish that your clients make more money out of those advice as well. Ganesh, so good having you. Thanks so much for taking the time out and speaking to us at Bloomberg Quint. And viewers, thanks for tuning in to this broadcast.